Hello friends, this is Raj Sastry from Raj Option Trading. Today is May 2nd, 2022. Hope you're all doing very well. So market is very volatile. We got to look at companies which are making money and good profit margin. So with that, in today's segment, we look at most beaten down stocks but still profitable and doing great. So with that, we look at some of these companies. So one such company is called Viva Systems. They're into healthcare information systems. Company has got very good profit margin, but stock is down off late. So let's look at most beaten down companies which are profitable. All right. So what we'll do is really we'll look at most beaten down companies which are still profitable, and we can take advantage of this pullback and buy such companies. And we are looking at companies with a sales growth more than 10%. This tells you top line revenue is growing. Profit margin is greater than 10%. That tells you this companies are making money. They are not money losers. Free cash flow is more than 500 million. That tells you these companies have no issues or challenges around the cash flow. And cash on the balance sheet more than 500 million. So these companies have got money to weather the storm. So these are some good companies, and these are most beaten down in last 1 year. So you're getting these companies at a bargain price. And we'll also do a quick deep dive on two of my favorites. One is Viva Systems, healthcare information technology. It is a cloud-based healthcare information technology platform. And then Intuitive Surgical, one of my favorite medical device play. It has got Da Vinci systems. It will help the surgeons how to make incisions and surgeries. So with that, we will finally conclude. So with that, let's jump in. Look, from a stock perspective, we got the list here. These are most beaten down profitable stock to buy on the pullback. Keep watching here. We got 1 year performance. Look, from a 1 year performance perspective, these companies are beaten down big time, as you can see here. And look, we got net profit sales growth here. Sales growth for all these companies is more than 10%. So top line is growing, no issue there. And look at the net margin. Net profit margin is more than 10%. So companies are making money. These are profitable companies. And then finally, we got here, we got a few other statistics here. And I would also look at price to sales ratio. If it is slightly higher, we got to be careful. These are growth names, but I like few of them. We'll talk through those. And look, we got here few more details here. Overall score, I like the overall score, higher the better. We got some great companies with high overall score. And keep watching here, both cash on the balance sheet as well as free cash flow. All these companies have got more than $500 million on the balance sheet, and free cash flow is positive. No issue around the cash flow, positive cash flow candidates. So with that, we also have cost of the buyback yield. Buyback yield tells you, are these companies basically diluting their share count. By looking at this here, none of these companies are diluting the share count. That's a good story. If you see a big negative here, that tells you companies are diluting the share count. And then you got cost of debt. If you see a high cost of debt here, more than say 5-10%, that tells you these companies are paying too much money, too much interest rate on their debt, which is not good. And then finally, we got bearish M score. When the bearish M score is greater than negative 1.78, be careful. Those companies could be susceptible for any accounting manipulation. We got two candidates here we got to be careful about. One is Zoom here. Zoom has got a little bit higher bearish M score. And then we got one more here, which is Etsy, which also has a little bit higher bearish M score. Could be a potential for account manipulation, but we got to do a little more research to say concisely. So I would watch those out. And then you got Sloan ratio here that tells you, are these companies' earnings made up of accruals? If that's the case, it's a little bit red flag. So we got few companies here, both Futu as well as Zoom here. company's earnings is made up of more accruals, so you got to be a little bit careful here. It may be okay for the newer age type companies with the digital presence, but typically I would watch out. And we got a few more names like that. And finally, we got solvency ratio. When you see a solvency ratio in red, that tells you, company, you got to watch a little bit carefully. Companies like PayPal, as an example, solvency ratio is 11%. If it is less than 20%, you got to be a little bit careful about such companies, but PayPal should be okay here. And we got one more here, Chinese company Weibo, solvency ratio is 11%. So I would keep a close watch on those and go from there. So with that, we got few names here. Keep watching the net profit margin. All are nice and high here. So also keep watching the cash on the balance sheet. I like the ones with nice and high, free cash on the balance sheet here. So let's look at few companies in little more detail here. Look, we got a few of my favorites here. One of my favorite here is Autodesk. Autodesk is a great stock, as many of you know here. Stock has been doing great, but off late stock has dropped off big time here. Right now, this company has got a little bit higher debt, debt on the balance sheet, and also current ratio is a little bit lower. I want current ratio to be over 1. And we got one of my favorite here, Veeva Systems. Veeva Systems is a healthcare information technology stock. They got a cloud-based platform. No negative, no red flag here. Stock is down. Look, stock is down 37% from 52-week high here. And RSI is also low. I think it's a good one to buy up here. Then we got Facebook or Meta, one of my favorite name. Stock came down big time, as you can see here, down 35% in 1 year. At these levels, I think it's a good one to buy. Stock is slowly trying to go higher after the earnings announcement. And we got few more here. I also love companies like Pulte Home as well as Lam Research. Both are great companies. No red flags here. You could buy these companies here and go from there. And we got a few more as we look through here. We'll look at those in the next slide. Look, we got few more names. We got more home builders, as you can see here. We got Adobe, one of my favorite stock. You could buy Adobe also slowly and accumulate. Look, Adobe is below $400. It's a good one to slowly buy and accumulate. Again, look, the reason it's coming down is valuation. Price to sales ratio is more than 10. That's why it's coming down. Still high valuation. So expect maybe some more drop off, but it will stabilize soon. And we got my favorite home builder, Lennar. Lennar is a good stock here. Look, it's doing great. Stock is down big time. Keep watching 1 year performance here, negative 25%. And I also like BlackRock here, one of the solid players in the tech, in the financial or fintech area. I think it's a great stock to buy for the long run. And we got Teradyne, one of my favorite here. You could buy some Teradyne here. It's also a good one to buy. Performance is negative 20% in 1 year. And we got few more names here. We got Medtronic and we got Intuitive Surgical. Intuitive Surgical is one of my favorite stock in the medical device area, along with Edward Life Sciences. You could buy this great company at a discount here. It's down. It's actually in 1 year down 17%. It's a great one to buy here. All right, so let's look at few more here and then go from there. Look, the list continues. We got a few more great names here, and we got good companies like ITW, Illinois Toolworks here. It's also a good one to buy here, down 13% in 1 year, as you can see. And we got a few more names here. I love even Agilent Technologies. It's also a good stock to buy here. It's also down 11%. You could buy such great companies. As usual, keep a watch on the overall score. Higher the better. I like the one with nice and high overall score. All right, what we'll do is we'll look at two companies in little more detail. First company we'll look at is Veeva Systems, ticker symbol VEEV. It's into healthcare technology, as many of you know. All right, so as you look through Veeva Systems here, look, Veeva has been doing great back in 2019 and 2020. Look, nice uptick here. And 2021 rolled along and company came down big time here. Look, big drop. And then 2022 came along, stock really tumbled. So look, big drop here. And it's got nice base here. I would say somewhere around 170, 180 could be a nice base, and it's bouncing off the base as you can see here. So at these levels you would wonder, should I buy Viva? We'll go into a little more details and see if Viva is worth buying here. All right, so from a quick snapshot perspective, look, Viva still it has higher PE ratio, 60, and a little bit higher price to sales ratio, which is 16. That's one of the reasons Viva is dropping. Current ratio is healthy, it's 3.7, higher the better. There is not too much debt on the balance sheet. That's also great. And analysts recommend buy, so it's a good one here. Revenue per employee is healthy, $337 million, which is I think it must be $337,000, which is a pretty healthy revenue per employee. And we got here a performance is really not good. In past few months and years, performance is negative, but long term, look, 5-year performance is still positive. Company seems to be doing very well. And from a top line perspective, company is growing the top line nicely in double digit. That's a great year. And look, it's got next year earnings per share growth is positive double digit. Next year sales growth is also positive here, double digit. So company doing well, top line is growing nicely. And now when it comes to bottom line, look, net margin is 23%, pretty healthy. Company is really profitable. And look, from a operating income perspective, it's doing well. Free cash flow is positive. Company has no challenge in the cash flow, and they got $2 billion cash on the balance sheet, no issues. Nice working capital, they can keep chugging along. And insiders are selling slightly, which is one of the reason it could be down, but no big deal here. It happens from time to time. Technical rating is sell right now. From a technical perspective, it's sell. I like the divergence between the technical rating and analyst recommendation. That's when I slowly start buying. And from Morningstar perspective, this company gets a B grade in financials, growth, and even profitability. That's always good. It's a good validation from Morningstar. Overall score is 81. That's great. And look, max drawdown within 1 year is 49%. I think that happens from time to time for all this high flying stock here. But look, from 1 year it's already down 36%. So we are not too far down from max drawdown. So that's when I slowly start buying companies like Viva. One of the reasons it's coming down is because still a little bit higher price to sales ratio. Don't buy too much, slowly start buying and accumulating. This can bounce back hard. All right, now let's look at Viva by numbers. Look, one of the reasons I like Viva is their earnings per share or EPS keeps growing. That's a good one, healthy clip. The sales also keeps growing. That's good. The top line revenue seems to be doing very well. And shares outstanding is pretty stable here. Not a big deal. They're not diluting the share count much at all. Operating margin is healthy and improving. That's also great. And net margin also going in a nice clip here. They're profitable company. And total debt to equity ratio is pretty stable here. I think they took on some debt back in 2019, 2020. They took advantage of low interest rate, added a little more debt, but they levered down from a debt level. That's good here. Still, look here, debt is very, very low here, completely manageable. That's one of the reason I like this company. Company doing very well from a top line perspective. Revenue is going strong, and bottom line net margin is also improving. I think it's a great stock to buy for the long term. All right, now let's look at next company, Intuitive Surgical. It's a medical device company, as many of you know here. Company doing very well, as you can see here. Look, nice upward clip here. Back in April 2020, COVID day, stock came down, but came back with vengeance, went higher. And look, 2022 rolled along here, and right from somewhere October, stock came tumbling down. Now it's resting on this nice support level right here around $239, $240. So let's see if it's worth buying up here. All right, so from a quick snapshot perspective, Intuitive Surgical is a $239 stock here and nice $103 billion market cap. It's an analyst recommendation perspective buy. Per employee, they have $583,000 revenue. That's a great clip. And look, stock has been down for last one day all the way to 1 year. But if you look at 2 years, 5-year, 10-year companies making a nice profit for investors, that's always good. And look, companies from a next year sales growth perspective, it's positive, a double digit, that's great. Next year EPS perspective, next year projection is good. So companies got a good projection for next year. And now let's look at a few more things here. From a margin perspective, solid net profit margin, 28%. The company knows how to grow top line and also grow bottom line. That's a great year. Company doing very well. Now finally, from a Morningstar perspective, gets a B grade in financials, B grade in growth, and B grade in profitability. I think it's a good score for Intuitive Surgical. Overall, company doing very well. I also like when analysts are saying buy, fundamentally good. Technical rating is saying sell. That means it's a good spot here. Temporary weakness, it's good to buy. And one of the reasons stock came down big time is, look, we got here PS ratio, price to sales ratio, little high. PE ratio is also a little high. That's the reason these stocks are coming down. So that's when I slowly start buying, taking advantage of the big drop. I think these stocks will come up nicely and bounce back. All right, from a quick by numbers perspective, look, earnings per share perspective, nice clip higher. That's a good here. Companies are growing its earnings. And sales perspective, nice clip here. They're growing their sales or the top line revenue. That's also good. Shares outstanding is pretty stable. They are not diluting the share count. That's great. Operating margin is a little bit struggling, as you can see here. It's still healthy. It's around 30-35%, but the trajectory is a little bit down, which is a little bit concern. But I think they will manage. This is attributed to all the supply chain issues that we are seeing of late, but I think they're trying to improve, as you see here. Net margin is pretty stable here. They're keeping it pretty constant. That's good here. Companies managing the net margin at a healthy level here, around say 30% or so. And one of the good thing about this company, they're not taking on debt. Look, the debt is very low and pretty constant here. So that's why I like this company. Company knows how to grow the top line and how to tighten the belt and keep the margin steady. That's why it's an Intuitive Surgical. It's a great company to buy, taking advantage of this market-wide sell-off. All right, now let's look at a quick conclusion here. From a conclusion perspective, when the market pulls back hard and when there's a market-wide sell-off, go after the quality stocks with sales growth, positive gross margin, positive net margin, and positive cash flow. You will typically do well if you buy such companies. There is not too much risk involved. Granted, stock can come down from time to time, but long term, these are the good ones. And also, buy stocks with good fundamentals. Few examples that we walked through are, Viva. We also looked at Intuitive Surgical, but you could look at other names like Facebook, Align Technologies, Global Payment Networks, Lam Research, Pulte Homes, BlackRock, Teradyne, and so on and so forth. These are all good companies. Take advantage and buy slowly. And when the price to sales ratio is high, understand there is a little bit high valuation, so buy them slowly, no need to rush. So with that, thank you very much. Happy investing and trading. Please subscribe.